There are macroeconomic risks coming in 2024 that you want to protect your money from. At least that's according to Blackrock, who says there's going to be a new regime leading to new economic threats. If you're unfamiliar, Blackrock is the world's largest asset manager with about $10 trillion in assets under management. And every year, Blackrock releases a new global economic report, and this year it is titled Grabbing the Wheel and Putting Money to Work. And the big themes that you'll see in this year's report are managing macroeconomic risks against what Blackrock calls this new regime. Now, I've already spent the time researching and analyzing the report, and I'm going to break it down for you here, but if you want to read it for yourself, I'll also put it for you down in the description. But there are three main themes of the report that I want to highlight today. Number one is that our economy isn't as strong as what many people think. Number two is that investors need to be more educated with their investments. And number three is that you need to look for new and unique investment opportunities. So let me start by talking about point number one, which is that our economy isn't as strong as you might think, starting by reading you the first line of this report. The new regime of greater macro and market volatility has resulted in greater uncertainty and dispersion of returns. Now, when Blackrock is talking about this new regime, the thing that they're talking about are number one, the higher interest rates that we're seeing, and number two is the higher market volatility. These are the two factors that Blackrock says coming together create what they call this new regime. But this is where things get really interesting, because now if you dive into section number one, which is titled Context is Everything, you'll see why they believe that our economy here in the United States isn't as strong as what many people think. The report says that the United States economy grew quickly in the third quarter of 2023, core inflation has fallen sharply, and nearly 7 million new jobs have been created since January 2022. These are the things that Blackrock says have been attracting all the positive economic attention by the media. However, Blackrock says that there's a little problem with that. Take a look. According to Blackrock, the economy hasn't been growing, it's just been climbing out of the pandemic hole. And then the diagram for you here. On this chart, you can see that the red line shows our growth of employment in the United States, and the yellow line shows what a typical growth in employment would have looked like, assuming that we did not see the pandemic. And what you'll see is that yes, after the pandemic, after that huge drop in employment has been rocketing upwards. However, this employment and growth is still below where we would have been, assuming we did not see the pandemic. So while everybody is celebrating the economic growth and the growth in jobs and the growth in the economy, Blackrock says that if we didn't see the pandemic, we'd be an even bigger economy with more jobs and a stronger job market than we would have seen today. The report says that our economy is on a weaker growth path, and we got to where we are today with more inflation, higher interest rates, and much higher debt levels. This is where you can start to see the problem that Blackrock is highlighting. Our economy today is weaker than we would have been had we not seen the economy. And despite it being weaker than we would have been, we also have high inflation, we also have higher interest rates, and we also have much higher debt levels. All these three things start to pose some problems in this economy that really isn't as strong as what many people think, according to Blackrock. And that's why Blackrock goes on to say that this is a regime of slower economic growth, higher inflation, higher interest rates, and greater volatility. This brings us to point number two, which is that investors need to be more educated with their investments. Now, before we jump into this, if you do want to start investing in financial education, my team at Briefs Media put together a free ebook on how to build wealth as an investor that walks you through things like the basics of how do you start saving money to more advanced things like how do you start investing in money, what are different types of assets, how do you start investing for cash flow, and how do you protect your assets. This ebook is completely free. So if you want to grab a copy of this ebook, start reading and start learning and investing in financial education, I got the link to how you can download this ebook for free down in the description below, or you can go to briefs.co/ebook. One of the factors that Blackrock kept emphasizing in this global economic report is that it is going to be more valuable for investors to become more of an active investor, meaning people who are more involved with their investments as opposed to a passive investor, is because we're seeing a lot of changes happen in the economy. And one of those changes that Blackrock talks about is changes with the government, and particularly with the government debt levels. Structurally lower economic growth and higher interest rates pose a problem for the ballooning United States government debt, because if borrowing costs from higher yields stay near 5%, that means the government could have to spend more money on interest payments than they do on Medicare in just a few years, and this increases the long-term risk of higher inflation as central banks become less aggressive on inflation. I know that was a lot, so let me break down what that means. The United States government has been racking up a whole bunch of debt, not just for the last few years, but over the last number of decades. But then it really ballooned over the last few years after the pandemic. Why does the United States government have all this debt? Because they keep spending money that they don't have. And in order to spend money they don't have, they have to finance the spending by borrowing this money. How do they borrow this money? Well, they like to go to the Federal Reserve Bank to borrow this money. That's one of the places where they borrow this money. Well, as interest rates have been rising, that means now the government, who has all this debt, has to pay this debt back at higher interest rates. And remember, the government has only one source of income. They get their money from people like you and me, taxpayers through tax dollars. So, as they have all this more debt, with interest rates that are rising, that means the debt becomes more expensive because the government doesn't have a 30-year fixed rate mortgage. Their debt readjusts. It readjusts every year, every 3 years, every 5 years. So now, as this debt starts to become more and more expensive because interest rates are higher, that means the government has to spend more of its money, its tax dollars, to pay back its debt, instead of giving things to its citizens with things like Medicare. This is where what Blackrock is saying is we're not that far away from our interest payments on our debt from exceeding some of our most expensive payments like Medicare. And as that starts to happen, that means our government costs every year are going to be rising. Why? Not because we're spending more money to give money to our citizens, but because we have to pay back all of our previous spending. And that could lead to more inflationary problems, because then how is the government going to keep paying for future expenses? Because it doesn't look like the government is cutting back on spending. In fact, it looks like the government is increasing spending still. So if the government keeps increasing their spending while our costs on this debt keep ballooning, that means the government's going to need more money. And if they can't generate that through tax dollars, they're going to have to turn to places like the Federal Reserve Bank to print that money. What happens when you print money? That creates more inflation. And if you have more inflation, well, we already know what happens when you have more inflation. That makes things more expensive. But this is coming at a time where what Blackrock says, the Federal Reserve Bank and central banks are becoming less aggressive. Like we saw in 2022, how aggressively the Federal Reserve Bank was raising interest rates again and again and again, and then they really slowed that down in 2023, and a lot of people now are projecting that the Federal Reserve Bank could be cutting interest rates in 2024. Now, we don't know if that's going to happen or not, but that's what people are predicting. So now, if the Federal Reserve Bank is becoming less aggressive on fighting inflation, but the inflationary pressures are still there, you can start to see why that poses issues into our economy, especially given the fact that, well, the government is going to have much higher costs just to service all of their debt. This is one of the risks that Blackrock is talking about, and this is where they say that you need to be a little bit more of an educated investor, because this can pose other threats to our economy and maybe even our currencies. Blackrock says that this means central banks will face a tough trade-off. If they want to stop inflation, they will have to keep policy tight. We think policy rates are poised to settle well above pre-pandemic levels. Ultimately, we see central banks living with higher inflation and hefty government spending and debt loads. In other words, Blackrock says that they are expecting interest rates to stay higher for longer because of all the issues that we just talked about, because of the government spending, because it doesn't look like the government's going to be cutting back spending, and then because of all these debt loads. All these things are going to put higher pressure on inflation, which should keep policy tight for the central bank, the Federal Reserve Bank, which means they are expecting the Federal Reserve Bank to keep interest rates higher for longer, and there are impacts to higher interest rates. For example, higher interest rates can slow down the economy, they can slow down the jobs market, they can hurt asset prices. And this is where Blackrock says it pays for you to be a financially educated investor and understand this and understand how the impacts of inflation, government spending, and interest rates can impact the economy and assets. Which brings me to number 3, look out for new investment opportunities. Because now if you're watching this saying, well, what do I do? What are the opportunities that Blackrock's talking about? I'm just going to go through what they are recommending. I'm not telling you what to do. I'm just going through the report, which is what Blackrock is recommending through the report. Now, Blackrock talked about a lot of different opportunities that they are investing in for their clients, and I'm going to highlight 4 of them. Number 1 is private credit. They say the capital pressures on banks are opening a path for private credit and non-banks to fill the lending void, part of the future of finance. In other words, now the interest rates are so much higher, it can become an attractive investment for investors to potentially lend their money out. Maybe you lend your money to corporations, maybe you lend your money to the government, or maybe you lend your money to private people, private individuals, because now, well, banks might not be able to fill all that need, and because of the higher interest rates, you can get a better return on your money. Number 2 is artificial intelligence. BlackRock says that we may just be at the cusp of this intelligence revolution in our view. Now, the thing that I want to caution you with is don't chase the hype. Understand what you're investing in, because every new and exciting thing creates a bubble because people start investing their money without understanding what it is that they're buying, which creates this huge boom, which causes this bust. But understand that, yeah, there's a lot of value with artificial intelligence, but don't just chase the hype, and understand what it is that you're buying and understand the risks with that as well. Just because something goes through a boom and bust doesn't mean it's going to die, but you got to understand the cycles and the psychological cycles of how asset prices move. We, BlackRock, see opportunities in climate resilience solutions offering flood, fire, and drought resistance. In other words, BlackRock is predicting more natural disasters to happen in the future, and to combat and profit off of that, they're looking at ways to make money off of things like flood and fire and other natural disaster prevention and also cures. We, BlackRock, think inflation will be structurally higher and see real estate and infrastructure playing a key role in strategic portfolio as a result. Why? Some real asset values or cash flows are linked to measures that correlate with inflation, think property prices or rental income. In other words, BlackRock thinks that inflation is going to be around, and as you have higher inflation, that's going to mean that rental prices also rise, so your income as a real estate investor will also rise to match that inflation, which is what BlackRock is saying, that they're looking for more real estate investment opportunities. So what is BlackRock saying? BlackRock is saying that number 1, our economy isn't as strong as many people think, because while we've been seeing this massive growth in the last couple of years, we haven't gotten to the point where we would have been, assuming we didn't see the pandemic. The second thing that BlackRock talks about is risks in things like the government and our national debt and our spending and our money, which is why you need to be smarter as an investor. And then BlackRock ends their report by talking about different places where they're looking to invest their money. Now, do not blindly follow a random guy on YouTube. Do not blindly follow a report. You need to do what's right for you, which is why you need to invest in your own financial education to make sure you are investing your money and putting your money to work in a way that aligns with your goals and your financial risks. So this is why you want to be investing in your own financial education. That way you can understand what's happening and then make a decision while understanding the risks that align with what you want to do with your money. Now, again, we have a free ebook at Briefs Media that I got for you down in the description, but this is where I want you to understand what's happening and then learn how you can use this information to your advantage. High housing costs will drive more Americans to become home renters instead of home owners in 2024. At least that's according to Zillow, who says that housing unaffordability will make the new starter home a single-family rental in America. Now, for those of you who don't know, Zillow is a housing conglomerate. Not only can they help you find a home to purchase, but they're also a real estate